one of the advantages we've seen and one of the drivers of companies going private or staying private longer, we could talk about them re-IPOing later, has been you can focus more on medium to long-term growth, right? Because it's all about growth and the equity part of the capital structure. The continuous quarterly reporting does put a lot of pressure on management to be a little too short-term focused. So that could be a healthy development, Tom, but obviously capital markets are going to push back really hard.
Interesting to say the least. Paul's been talking about all morning. Is Troy Gayeski, is Future Standard, are you going to participate in, is this the right phrase? The Musk IPO?
Oh, that's right. SpaceX, right?
Are we?
Yeah.
Yeah. Well, look, so through some of our venture capital portfolios, we have exposure on behalf of clients. And so, yes, there will be participation in that on the behalf of our clients. But in terms of taking a position in the IPO itself, the answer is no. Our liquid multi-strategy really doesn't trade IPOs out of the open. And look, we wish the best for those late stage private offerings. But as you know, as they get funded later and later, the valuations tend to creep up and up and up. I mean, the one advantage SpaceX has over OpenAI and Anthropic in this race of trillion-dollar IPOs is there is some diversification benefit. If you look at OpenAI or Anthropic, they're very similar to hyperscalers, but at least in SpaceX, you're getting a different growth vertical that can provide some degree of diversification and may cause institutions to pay a bit more.
Paul, vertical. That's
the way we roll.
You say vertical. It's impressive.
Troy, we had this sell-off in the market, right around the beginning of the Iran war, but then we had a sharp rebound here.
Did we fall? No, yeah, you blinked, you missed it, right?
What do you make of that there?
Yeah, it's really crazy. When you go back and really since the Eurozone crisis, every correction / bear market, mini bear market has been V-shaped with the exception of 2022. Right, and you think about the reason that wasn't V-shaped is it just took so long for markets to adjust to materially higher front-end rates. I mean, the Fed's going from 0 to 5.25, and they're draining money supply at the fastest pace since the Great Depression, and that was an accident. Obviously, this time was on purpose. When you think of the technicals behind that, so we talked about this in the past to some extent, where you have a long-only buyer base or a retail buyer base that's been conditioned to never sell. Right, just hold through. Then what happens is you get this seismic shift, tariffs, Iran war, the large multi-strat hedge funds start selling more, selling down their longs, putting on shorts. The trend followers flip from either long or neutral to negative. The risk parity managers, which manage their books to volatility, as volatility expands, they cut their risk, and you have this sharp decline. You reach a clearing level, your retail comes in, multi-strats start to relever, and it reverses very, very rapidly. But this has certainly been a V-shaped recovery for the ages, man. I mean, it's even more violent than Liberation Day.
Troy Gayeski with us. Futures up 26, now up 14. They've pulled back a little bit. The president still speaking over at the Death Star with Mr. Kernan. A whole bunch of headlines off that. We'll get to them here in a moment. We are advantage of Troy Gayeski, Chief Market Strategist at Future Standard. So, if you're at the Massachusetts Institute of Technology and you look at what researchers have done with extrapolation, they use least squares polynomial fits.
Hike.
That's what the Red Sox do in their infield. Can you extrapolate, MIT1, earnings and revenue? Can you take the glory double-digit moment we're in and extrapolate?
I've always said, it's hard enough to look 12 to 18 months forward, let alone 24 to 36, right? So
we used to routinely do 3-month guesses in the back of a research report.
Exactly, 3 months, right? So the key, I think, now to remember for this year's earnings and early next year is you still have a relatively strong consumer. You still have massive AI infrastructure spends, which obviously feed the whole semiconductor complex and business fixed investment complex. And that makes it potentially achievable to grow revenue 9% in the S&P and earnings at 17%, right? You should continue that strength into next year. But Tom, past Q1, Q2 of next year, we need to start seeing a material AI ROIC to really justify increased spends, right? Or that's when you could get into earnings trouble. So the biggest obvious risk to markets right now is the 4 hyperscalers sit around the table in a non-oligopolistic fashion, and they say in mid 27, you know what, guys, we haven't metaversed all this money, but like we torched a lot of it.
What?
Metaversed? Remember the metaverse?
It's like something Scaramucci would say.
No, the metaverse. Remember the metaverse? That was Zuckerberg's big plan to create an alternative reality. And there's
I tried to ignore it.
$77 billion gone. No, so they sit down and they say, hey, like we've spent more money than potentially we should. We're not getting the AI ROIC, and they start to flatline their spends. That would certainly be a correction-causing event and would suck a lot of GDP growth out of the economy. So that's one of the most known risks. And I think you can say with confidence that's not going to happen in the next 12, 15 months. After that, you have to at least be aware of
nicely summarized.
Yeah. So what is from your perspective, the AI play now? Because at least in the first 2 or 3 years, it was, let's just throw money at this thing. And anybody who was throwing money, the stocks were really rewarded if you could get AI into your story somehow.
Yeah.
Now it seems like the market's a little bit more discerning here.
Yeah, look, I think, jokingly, you're at that stage in some cases where companies add AI and their share price goes up, and then, the guys that short look at that and laugh, and then they kind of bury it within a day or two. But in our business, right, the biggest exposure we have to benefit clients is through sort of the infrastructure play, whether it's digital infrastructure financing, whether it's plays on continued spends like power control systems. That affects not only power control system manufacturers, but also those involved in HVAC and cooling. That has been one of the most profitable ways to play it. And the good news is you don't have to pay unreasonable prices because, in middle market private equity, you're entering somewhere between 7, 13 times EV to EBITDA versus the Russell 2000, which trades roughly at 19 times EV to EBITDA.
Troy Gayeski with us, and we continue. Chief Market Strategist, Future Standard. Nice long conversation, valuable conversation with him this morning. We say good morning the way you choose to listen to us. Thank you so much. Major shout out, 99.1 FM, Nathan Hager Radio.
Yep. Oh, I like Amy Marsh. She's my DC contact.
And she's, BU hockey and all that. I mean, she's like
University of South Carolina is what she does.
It's good to be down there yesterday to see Mr. Hager.
Oh, yeah.
He was shutting down his day. He was heading for the door when I walked in.
Yeah, lunchtime.
Hey, Adams Hotel. Whole thing. We say good morning to Washington. On up to Boston. Good morning, Sirius XM, channel 121. On YouTube, we are humbled by the distribution. Thank you so much. The way to do that is to sign up at Bloomberg Podcasts. And we are live to you and then taped later at some point, which I haven't figured out yet. But we're there on YouTube as well. The VIX 19.02 right now. Troy, I look at the entire setup here. In the backdrop, the thing that's out there in every conversation is our debt and our deficit, whether it's government or corporate. Ken Rogoff and Carmen Reinhardt make a big deal about you got to combine both. Discuss the backdrop of debt fueling our nominal GDP.
Yeah, so when you think again about maybe more obvious risks that Tom, even you and I can figure out, right, is the deficit situation is to some extent unsustainable, right? We're issuing, let's call it 5.8 to 6.2% of all the treasuries ever issued in the history of the country. That's a big number. Part of the reason why the Fed really will have pressure to bring the front end down faster to control that back end of the yield curve. But if you think about on the future, right, if there becomes a situation where markets at least balk a little bit at financing the back end of the curve, that turns again into one of those classic scenarios where you have a bear steepener, maybe an outright bearish move from 2s, 10s, which in turn causes multiple compression. So think about what we just went through with the Iran war, right? One of the reasons it was briefly painful in liquid markets is you had bonds selling off at the same time you had equity selling off. And that, again, is one of the more obvious risks. Not this year, not next year, but unless we can continue to grow nominal GDP at 5 to 5.5 and constrain government spending to 1 to 2, it's a risk that's becoming more and more obvious.
In the equity markets, we had a rotation, Troy, kind of starting late last year out of some of the high growth, high multiple stuff into maybe some of the more cyclical, maybe even smaller mid caps. I saw a little bit of a reversal back into some of the big cap tech names. How do you think about that rotation?
Yeah, so it's funny. So in middle market private equity, we always talk about growth at a reasonable price. Yep. It's been really, really hard to find in public markets, really since QE3. You go back to QE3, it was really more of asset inflation exercise than a way to really break a disinflationary cycle. You started to see, hyperscalers, let's call it the Mag 7 minus Tesla, top 10 minus Tesla, at borderline growth at a reasonable price levels. So lowest multiples they've been in quite some time, still very tremendous growth in the near term. And so it's logical that once you hit that clearing point and you start to rally back, that some flow goes back to what are clearly some of the greatest companies mankind's ever seen at some of the lowest multiples they've been at in quite some time.